Cast is now starting. All attendees are in listen-only mode.
Hello and good morning, everybody. Thank you for joining us um, in the continuation of our webinar series. This week, we are discussing the impact of geopolitical events on the global shipping market and how we foresee this trend evolving over the coming months. Um, Let's get straight to it. Today, the presenters are myself, Prashant Singh. I'm a director with CW Group out of CW's Mumbai office, and my colleague, Vanderson Teixeira, who's a business analyst and works out of our Lisbon, Portugal office. We will be navigating you through this presentation. So what's on the agenda for today? It's a brief description and an introduction to our company. We will then have a macroeconomic overview. And before we delve in deep into the sea freight analysis and sort of the outlook for this sector going forward. So without much further ado, I want to introduce you to what our company is and what we do. So CW is actually present across 3 different verticals. We have the advisory vertical, the research vertical, and the media vertical. And within the advisory vertical, we work across many different sectors and with global consultants and leading institutions like the World Bank, the International Finance Corporation, as well as several different wealth funds out of the Middle East, for example. We provide consulting and advisory expertise on a very diverse range of portfolio, from defense to chemicals to infrastructure. In fact, our portfolio now includes, projects such as circular economy, evaluating the circular economy potential of various industries in Northern Africa, as well as looking at plastic leakage mitigation within the Western Africa region into the marine ecosystem. So we have a very broad range of expertise. Within our research profile, for which we are far more known, we focus on producing syndicated reports on areas including cement, building materials, coal, petcoke, as well as paper and pulp. We have many flagship products, including the volume forecast report and the trade prices report, which give both biannual and quarterly understanding of where the global cement market is and where we expect it to go. We also have commodity price assessments for cement and clinker, which I will be giving a little bit more detail about further in this presentation. And under the media umbrella, we provide access to our vast online database of articles and information. We have newsletters on cement, building materials, petcoke, bulk shipping, paper and pulp, to provide you with a quick understanding and grasp of what is happening in the world on these sectors on a daily basis. We are also now slowly but surely returning to our in-person meetings, where we are doing conferences. And the next scheduled conference, after a very successful Slag and Ash Trade one in Cologne, Germany, just held earlier in May, is the CW Cement and Solid Fuel Summit 2022, focusing on the Middle East and Africa, which is set to happen in Dubai in late November this year. We also have another Summit of the Americas scheduled in early December of this year. So if you want to understand and are intrigued to know about these two different conferences, please do not hesitate to get in touch with us. So without further ado, when we proceed further, these are some of the relevant reports that I was talking about: the Global Cement Trade Prices Report, the World Cement and Clinker Sea-Based Trade Report, which is also updated annually, and the Global Dry Market Cargo and Forecast Report. In these times, obviously, these reports are becoming much more relevant given the fact that the supply and logistics situation has not improved over the last 2 years since the pandemic hit. And given what is happening in the world economy and other geopolitical events, this scenario seems to be for sure at least just as uncertain for this and maybe possibly the next coming year. On the next slide, you will see the two price assessments I was talking about. These are price assessments focused specifically on the Med Basin and the Persian and Gulf and Arabian Sea. The Med Basin is obviously very interesting because it is a major export region, as well as the Persian Gulf. And we track this on a bi-monthly basis with relevant information and market insight and news coming from these two different markets. And if you're interested in sort of learning more about these two products, please do not hesitate to get in touch with us, and we can share with you some more insights about what these products are and how they can sort of help you navigate and better understand these two very important markets. So here we are, we find ourselves at the beginning of 2022, actually half of 2022, nowhere clear in terms of recovery, nowhere clear in terms of the certainty of where economic growth is going. In fact, if I may say so, we are facing even a more uncertain time this year than we were at this point last year. Recovery is now slowing down globally across the world due to multiple reasons. If not most due to sort of the rising energy prices and the sustained level of energy prices. Yesterday, I think Brent crude hit $125 a barrel, which was the highest since March 13th. And it only dropped down again because OPEC said that they might consider raising output, which is a big if. I don't see any reason why they would substantially increase output because obviously they stand to gain as long as elevated rates remain elevated. They get an increased share of revenue. This obviously, unfortunately, affects commodity importing nations, which are now facing high and elevated levels of inflation at levels that have not been seen for decades. In the US over the past few months, inflation levels have reached levels that were seen like 30, 40 years ago. And now we see the Federal Reserve raising interest rates, which has a definitely cascading impact because it now takes away money that was going to be invested in emerging markets, and it sucks up those money and brings it back to the US and major Western markets. We're into sort of safer currencies because that's how the tapering works. And so now we see growth rates in emerging economies slowing down. Unfortunately, this year, there is an unfortunate confluence of events where we see the Chinese economy, which has been growing very, very strong over the past 2 or 3 decades, slowing down substantially and quite a lot due to its sort of zero COVID policy approach. Now, there are many reasons why China has adopted that approach and why it's unlikely that they will change that approach due to many political compulsions, but that has a very big and cascading effect on global growth prospects. And so the IMF already in April reduced its growth prospects from 4 point something to 3.6% this year. I can assure you that in their second half update of this year, they will further reduce their outlook. And at the beginning of this year, there was no talk about a possible recession in the US economy. Now there have been multiple reports, multiple investment banks proclaiming that the US is definitely bound for a recession in 2023, which will have a massive effect on sort of global growth and outlook. So we are not out of the woods yet. And this is, of course, not even talking about what is happening in Russia and the Ukraine and sort of well, possibly one could say the self-inflicted economic pain that Russia is going through and the devastation that it has imposed on sort of what is happening in the Ukraine. Russian economy is expected to contract by 12%, and most people would say that is a generous estimate right now, whereas Ukraine could see GDP fall by about 35%. But if you look at the news and you see what the news, if you look at the reports coming out of the region, one possibly would say that those estimates might and definitely will be revised upwards, unfortunately. And when we go to the next slide, these are some of the sanctions that is affecting Russian economic growth. And by virtue of the fact that Russia and Ukraine were major producers of like commodities, Ukraine especially of agricultural products, and Russia both of energy and agricultural products. Any sanctions that have been imposed on on Russia has a cascading impact on the global price of especially commodities. And these are not going to go down anytime soon. So elevated rates of inflation, despite what you will see is further tightening of central banks, is here to stay until this conflict comes to a sort of stalemate or a peaceful negotiation is conducted. Russia is now being hamstrung in terms of the countries it can export energy to. Europe is weaning itself off, but at a very, very high cost. But perhaps better late than never. But it will have tremendous impact on sort of the impact on economic growth. It's estimated that if Russia turns off all gas, the German economy could lose upwards of 200 to 250 billion euros per year over this year and next year in terms of economic output, which is extremely significant. That is, of course, not to say what is going to happen in Russia, within Russia, in terms of the devastation economically because of its inability to export anything and access the SWIFT bank transfer system. So the outlook for this part of the world in terms of the CIS and Russia is going to be extremely, extremely challenging. And Europe, by virtue of its closeness and reliance on Russian energy, will take a hit. The question is how much. And the rest of the world is already suffering in terms of elevated commodity and food prices. So the end does not look at any time soon in terms of the elevated levels of prices that we're seeing for commodities, regardless of the increase in production by the other OPEC members. Crude oil prices are not expected to come down below $97 until next year. And even at those levels, those will sort of hamper most emerging economies coming back to pre-pandemic levels of growth, and let alone the lag in being able to bring hundreds of millions of people out of poverty, which has been pushed back first by the pandemic, and then second by this wave of increases in prices for possibly up to a decade or more. So these impacts are not just short term, they are very long term and have devastating impact on sort of the lower income economies. And here is just a short snapshot in terms of where inflation rates are. As you can see, inflation rates in Russia, India, Brazil, the US, extremely high, elevated. These are levels hitherto unseen, at least for India and sort of the US for many decades. But this is now sort of become the expectation and norm that this will be the levels that they will see throughout this year. So the dynamics in terms of our own price expectations are changing. And this will have a devastating impact in sort of purchasing power the longer these rates stay at these levels. On this slide, what is a quick grasp of sort of where the inflation rates have peaked this year and sort of where they're supposed to go. As you see, 2022 is a bad year for the advanced economies. They're seeing levels of inflation that have never been sort of forecasted or accounted for in terms of their outlooks. The Fed usually talks about inflation less than 2%. Here they're dealing with 6, 7%, unheard of, like 3 times their expected goal. And that's why you see the talk of multiple rounds of interest rate hikes, which will, of course, reduce the levels of inflation, but also correspondingly reduce consumption levels and therefore hamper growth. And that's why the fear is that there might be a recession in the US economy coming next year. Russia, of course, is an open question. Inflation is already like 20%, but who's to say it won't increase, given sort of how long and how far this conflict is dragged on and the damage done to the economy in terms of access to adequate financing. Crude prices are at historical highs again, with very little chance of sort of reaching the optimum level of between $60 to $75. Of course, on one hand, you have the Russia-Ukraine conflict. In Asia, you have rising conflict between, or tension between China and China and Taiwan. The nuclear talks between the 5 members and Iran have not had any conclusive result. So all of these all of these factors are playing into high levels of insecurity and anxiety, and you are seeing these levels of prices with very few expectations that these major points of conflict will see any positive resolution quickly, and therefore have that effect percolate throughout the economy. The earliest we can hope to see some sort of leveling out will be 2023, and that is the expectation sort of across the board. But thank you for your attention now. I'm going to now pass on this part of the presentation to my colleague Vanderson, and he will take you through the important aspects of this analysis. So over to you, Vanderson.
Thank you, Prashant. Hello, everyone again. So to start with the sea freight analysis, I am going to present you the global freight rate indexes, which are also covered by our bi-monthly price assessments for the Med Basin and Persian Gulf Arabian Sea and East Africa, which with a much more detail in these price assessments. As you can see in our chart here, last year we started to see an upward trend in terms of the Baltic Dry Index, witnessing an increase of more than 60%, which was caused not only by shipping constraints, but also port congestions in China and demand recovery for commodities. However, in the first 5 months of this year, we are seeing the Baltic Dry Index declining slightly at a 0.3% when we compare to the first 5 months of 2021. And more recently, actually yesterday, the BDI reached 2,633 points. And this was mostly due to gains in the Capesize segment, outweighing losses in the Panamax and Supramax. More specifically, in the Panamax, we are seeing for the past couple of weeks reduced fixing volumes and build-up tonnage in most oil engines, which is also resulting in reduced bids increasing. North and the south of Atlantic is also witnessing a decline in terms of volumes in the past couple of weeks. Meanwhile, when it comes to the Supramax index, we see European holidays dimming activity levels, and we also see the Atlantic with limited inquiries from the US Gulf, while the south and east coast of South America remains extremely balanced. What does that mean in the short-term outlook? In the short-term outlook, we expect to remain positive. However, due to the ongoing geopolitical events, there is still uncertain in the short-term outlook due to a series of factors. This includes, first, negotiations between the Pacific Maritime Association and the International Longshore and Warehouse Union, the ILWU. These negotiations have been happening for quite some time now, and they stopped for a little bit in May and resumed negotiations yesterday. So talks are still happening, and because of that, there is a high anticipation for what is about to happen, and this is, of course, mostly by US shippers. So what we see is that if these labor talks are stalled or halted any further, this could have numerous detrimental effects on this already constrained scenario. And this is actually more aggravated right now because in July is when most of the contracts are expected to be renegotiated and renewed. So we see a certain urgency when it comes to having these negotiations happening and having a positive outcome of this. Of course, we see that given the past history of these negotiations, there is a very little expectation that this should be solved quickly. However, as I mentioned, it's an urgent matter by now. Other factor that is also creating uncertainty to the BDI outlook is China's lockdown. We are seeing now China slowly easing its lockdown measures. However, we have the possibility of new lockdowns being adopted by Shanghai. That's not something that is out of the plate. When with that, we would see more ports closure, we would see more instability in terms of delays in shipments, mostly in China, but also in the US. This would have a spillover in all regions. We also see here China and Taiwan's conflict posing a threat to trade as well. And of course, we have Russia's invasion of Ukraine also highly impacting the global freight rate and also posing uncertainty to how this scenario could come, resulting in the short-term period. In this next slide, we focus here on the global container freight rate index, and we see the trend from mid-2019 until basically now, the end of May. We have seen the container freight index has increased substantially as a consequence of many factors. This included the China zero COVID strategy, which has deeply impacted the economy, activity, which therefore leading to port congestions and delays, not only at the origin ports, but also at the destination ports. That's why we have been seeing long delays in US ports, which have been easing for now, but we don't know how the short-term outlook would come. This, of course, continued in the first months of the year. However, was more aggravated by the Russia-Ukraine conflict, with container freight rates increasing by more than 130% in the first quarter of this year compared to last year. We are starting to see a slow decline in the past couple of months as scarcity of exports from China freed up a little bit of space for container vessels due to the lockdowns that were imposed by the COVID strategy. However, for the remainder of the year, we expect the freight rate index to slowly stabilize. And we need to see how this will go. It's again very uncertain, as well as the BDI. So we need to see how geopolitical events are going to impact these indexes in the next couple of months. Now, in this slide, we decided to select a few ports to show you currently what is their delay days, and to give you a perspective of how this has been changing since March at least. In this page, we can see a little bit of more focus on US and China ports congestions, and this represents what has been happening in the week of May 24th. We see here US ports having a movement towards a normal, let's put it, normal delayment in terms of like days of shipments. While China ports, we see congestions increasing moderately. We also see here, in terms of China, for instance, since the beginning of March, to give a little bit of example, total dry bulk congestions levels at ports, they increased by around 30 to 40%. So we can see that this scenario was getting worse from when we compare to the beginning of the year. And of course, the US, even though we are seeing a normalization in terms of ports deliveries, as I mentioned before, the negotiations between the Pacific Maritime Association and the ILWU, they are expected to determine how these congestions will basically go on. So if negotiations go well, we can see ports stabilizing and at a normal level. But if they keep to be dragged on, we can see ports congestions also increasing the next couple of months. Meanwhile, in Europe, we see the situation getting worse. Importers are taking longer to pick up their containers from overflowing terminals in ports in North Europe. We have ship delays increasing. We have particularly large vessels seeing delays increase in the Asia-Europe trade route. And we also see the trade route between Far East and North Europe seeing container ships normally, as of now, needing an average of 101 days to complete the full round voyage. And of course, with the Russia-Ukraine conflict, we're also seeing the scenario getting worse as Russia blocked access to the Black Sea ports, which is also aggravating the situation and creating more congestion in several ports around the globe. In this next slide, we can see Asia Europe nominal capacity by operator. We are seeing that since January to April, there is an increase in container capacity. However, this has not been reflected in container freight rates. Freight rates continue to increase due to high supply chain issues and increasing demand, which is also affecting dwell time. These new capacity additions, they are expected to be more expressive in 2023 and 2024. Even though we see here that the capacity fleet has increased by 10.4% year on year in this same period, in the January and April period, we are expected to see this more exacerbated in the next couple of years. We also decided to show shipping companies' profits and to give you a little bit of a better understanding of how the market is behaving. As I mentioned, we have shipping freight rates increasing. Therefore, container shipping lines are also seeing record profits. For instance, we see carriers in 2021 seeing substantial increase in profits. This was not because they had higher volumes, but they were mostly because there's a higher freight rates. For instance, we have some companies reporting that in the fourth quarter of last year, they did not carry any more containers than what they did in the fourth quarter of 2020. So we see how this correlation between the freight rates and the operating profits by these container shipping companies has been behaving in the past couple of months. For this year, we expect container ships lines to see an estimated 163 billion in operating profits. This would basically represent a growth of 8% year on year. An example that we can speak about is Maersk, that reported that in the first quarter of this year has delivered its best earning quarter ever. This increase in earnings are driven by, as I mentioned before, freight rates and by also contracts being signed at higher levels. In the first Q, we continue to see freight rates at elevated levels as COVID-19 and also capacity shortages continue to disrupt the supply chain and logistics industry. And therefore, this has been positively impacting all of these major container shipping companies, as you can see in the chart in our slide. For the remainder of the year, we are expected to continue to see an increase in profits. Maersk also mentioned that this is going to be based on a strong first half of 2022, as well as higher contract rates, while we are expected to see a slight normalization in the second half of the year. Of course, overall, 2022 is expected to be very positive in terms of operating profits for these container shipping companies. Now to leave you with our closing remarks and end our webinar, we can see that global economic growth is expected to continue to suffer pressure from recent geopolitical events, as well as the COVID-19 related restrictions. This is especially in China, where we still have restrictions, even though they are starting to ease. In terms of inflation, inflation is expected to stay at elevated levels, impacting economic growth prospects for major economies in the long-term period. This is expected to have an impact in purchasing power, therefore affecting also economic growth of major economies. When it comes to container freight rates, we are expected to see still elevated levels for the remainder of the year, while in capacity, the trend is expected to continue as freight rates as well. We have been seeing increased capacity last year. This is expected to continue in the remainder of the year, even though this is not resulting in declining freight rates. And to finalize, lastly, we have carrier shipping companies also continue to see an increase in earnings in the first quarter of the year. This is, as I mentioned, mostly due to sustained demand and ongoing port congestions, and high levels of earnings and profits is expected to be carried throughout the year. So to finalize, I would like to thank you for your time, and we'll see you in our next webinar.